this idea of no landing to me is kind of silly, right? Because no landing implies that we're still at 30,000 feet cruising along in the air. That's clearly not the case. This is not a perfect economy. We had a year-over-year change in GDP last year of 0.9. That is stall speed, right? That is below the natural rate of growth, which is around 2%. So that is definitionally a recession. Now, they're not going to call it a recession because of the fake jobs numbers. Here's a crazy thing, Michael, that I talked with Rosie about. I think I may have mentioned this last week. The 1.5 million jobs, quote unquote, that were created in the last year. All those are this BLS nonsense of the birth-death ratio.
Right.
But here's the crazy thing. Rosie pointed out, and I just saw it again, corporate bankruptcies surged to new highs, particularly in the fourth quarter. And so if companies are going bankrupt, how can there be net positive birth-death, right? Just definitionally. And so they're clearly just ignoring that and saying, hey, we're still in an expansion. Therefore, technically, the birth-death ratio is X, and we're just going to ignore that corporate bankruptcy data. And the number of bankruptcies / layoffs, I don't know, those all seem to be up and to the right. It comes down to liquidity. Ultimately, everything comes down to liquidity. And so on the negative side, U.S. money supply growth went negative, right? Hadn't been negative for almost 100 years, for 96 years. It's pretty incredible when you think about it, 96 years straight of increasing the money supply. But that leads economic activity by 16 months. So you're going to have a downturn, and inflation is going to moderate. And the shelter component of inflation is collapsing. So that's all going to moderate. And I don't think it's going to go negative and deflationary, but it's going to moderate. But the thing that is countervailing, and the cross-border capital guys, I don't know if anybody knows them, but they are amazing.
Oh yeah.
I mean, just amazing. Yeah. And they have the chart, and I've been tweeting it out a lot lately. It's $1 trillion with a T, trillion since October. And, we just did a webinar on China. So we have a team on the ground in Shanghai, and we do growth equity investing in China and getting ready to raise a new fund. And so we did a webinar on Wednesday, and the team had gone through all the data and all the things that are happening with reopening. And they showed this video that was actually really cool. We had one of our analysts go out in the street with her iPhone, and she just took a picture of downtown Shanghai in October, and it was like a neutron bomb went off. I mean, there were no people, no cars. I mean, it was spooky. And this wasn't like a ghost city. This was Shanghai. And then she went out a week ago, stood in the same spot and was doing the iPhone thing. And it was like what you see in the movies, right? Bumper to bumper traffic, people with shopping bags, going in and out of the mall, chowing down on, the amazing food in Shantundi, which is like this awesome kind of outdoor marketplace and retail, high-end retail. Awesome. If you ever go to Shanghai, go to Shantundi and hang out. It's just awesome. And I love the story of Shantundi. So it was a slum. And the slum was notorious because the ratio of toilets to people was 1 to 40. There was one toilet for every 40 people in Shantundi. But the point there was China is reopening. But again, the focus was on consumption and evolution of the middle class. And so, we're all debating this whole nonsense of trade wars and that. And it's like, they don't care. They just want their people to get jobs, to spend money, and to live the life, that we pursued from 1970 to 2020. And it has to do with financing of the financial system. So, Japan in particular is one of the primary carry trade financing centers and has been for years because they had zero interest rates. So you could borrow at zero. You could take that cash and go buy other assets, whether it was U.S. hedge funds doing it or European hedge funds doing it or whatever. And basically, the Bank of Japan facilitated that whole thing by just being the buyer of last resort for the bonds. Because who would buy a bond that paid zero interest? Who would buy a 30-year bond paying zero interest? Well, no one. So the Bank of Japan waves it in, prints money, puts that money into the system. Then foreigners come and borrow money from those Japanese banks, pay them basically no interest, but they don't need interest because they're being kept afloat by the Bank of Japan. The Japanese carry trade and just the money actually ends up in meme holder accounts because Goldman borrows a bunch of money from a big Japanese bank and starts buying stuff. Well, then they offer, well, it's not Goldman, it's UBS and Merrill Lynch and Robinhood. And then they give all their users credit. So that's why margin debt in the United States went like this. So the two things I watch are margin debt. So if margin debt's expanding, then the meme stocks are going to rip. If margin debt's contracting, meme stocks are going to get crushed. And that's exactly what happened. Last year, margin debt collapsed because people had to make margin calls because stocks were going down and it exacerbates. But starting in October, China floods the world with money, and that money finds its way into the big houses. Ken Griffin's house first, always. And no, I'm serious. I mean, they had their record year last year, right? And
hey, constitutions aren't free.
Absolutely. That's exactly right. And if you're going to crush the souls of the Dow that wanted to own that piece of history, you have to be pretty good at your job. So, anyway, we digress. And
margin debt. What was the other one?
Debt, margin debt. And the second one is these global liquidity, because your point again is your question is so insightful in that, well, wait a minute. It looked like U.S. liquidity was expanding, but then it contracted. Well, then how is global liquidity suddenly? Well, it's because, and you see this in currencies. It's because I believe there is a concerted collaboration, right? That these central bankers get together and it's a process of saying, okay, Europe, ECB, you're going to have the strong currency. So the rest of us can devalue our currencies and be mercantilist and sell a lot of stuff globally. All right. So you're in the hot box for the next 9 months. Then we'll get together again. And now you, Japan, you're in the hot box, or you, the US. Last year was the US's turn, right? The US had to have the strong currency. So the euro could be super weak because Europe was on the verge of collapse. Yeah. Remember all the dire things about in Europe? European stocks have crushed it because they were able to devalue and sell a bunch of stuff, machine tools and cars that they wouldn't have otherwise been able to sell because China was closed. So, and the yen was, obliterated. Yeah. Obliterated, down 30% through October. And then, bam, recovered 2/3 of that. And so I believe there is a coordinated liquidity provision. But at the end of the day, unfortunately for the masses, it is all net fiat generative, which means net inflation generative, which means net channeling of wealth to the top of the pyramid and impoverishing the masses. And that, I think, is unfortunately how it works. The problem is, Michael, that if you get a $200 a month raise, it's nice, it's good, awesome. But if your mortgage payment goes up by $1,000, you're screwed.
Yeah.
And that's what's happening with adjustable rate mortgages. I just went through it, right? I told the story. 10 years ago, I did an adjustable rate, 10-year adjustable. I don't even remember doing it. And my rate went from 3 to 7.
That's no good.
So I'm quickly refinancing, which has turned out to be a total nightmare. The thing is so funny. Banks hate business owners. They love W-2 employees. They're like, if you could just make way less money, but have it be on a W-2 instead of being the owner of the business, we'd like you way better. I'm like, that makes no sense. Be sinister for a minute. It makes perfect sense when you realize that why do they love the derivatives? Because you can naked short the shit out of Bitcoin and depress the price and foment fear. That's why they love the derivatives. Great conversation. I do want people to kind of timestamp that prediction that you had, which is there is a resolution coming, and it's going to have to do with a co-optition, shall we say. And bring it back to based, right? Everybody's going to get based. Everybody is going to because the future is going to happen. Blockchain is going to happen. The rails, ACH and FedWire, SWIFT, it's going away. It's going away. And whether it's all going to be ruled by the new or the old, it's probably this.